So let's turn back to the market rally that we have been tracking ever so closely. The S&P 500 hitting its 50th record of the year as investor sentiment remains positive following the presidential election. Joining us now, we want to bring in Alexander Morris, FM Investments CEO and Chief Investment Officer. It's great to have you back here, Alexander. Let's talk about the sentiment right now within the market. It almost seems like nothing is going to stop this move to the upside that we have been seeing more broadly. What's your take just on where things stand today?
Well, I think you're right. Nothing's going to stop this move to the upside. It's a little bit of a surprise, right? Going into this, the Trump trade was seen as short equities and bear steepener. What we got was bear steepener plus long equities. And if you were short equities in any way going into this, you were really disappointed, and you're probably going to be. And as we go to the fundamentals you're just talking about, things are probably just going to get a little cheerier for companies over the balance of the year. So it seems like being long mega cap stocks stayed to be a good idea. Being long stocks in general is a good idea. It's probably a good play through the end of the year.
You know, Alexander, taking you into some of my conversations with friends over the weekend, many of them saying, hey, 50 all-time highs for the S&P 500. There's a lot I've been cheering about, but should I be cautious right now, especially where the exuberance has seemed to play out in such a manner that investors are trying to figure out, okay, what, if any, is the next shoe to drop at this point? Because now it's going to seemingly, or at least history would suggest, at some point it's going to turn into a show me story that deregulation would have to lead to more of the potential acquisitions or deal making environment, or that you would, in the crypto landscape, that you would need to see more purchasing from government entities. So all of these things have to have some type of element to show up to say, all right, this is actually happening, and what has been touted as the Trump trade is going to play out because of either policy or some other matter as well.
Markets always are looking for that thing to say, here's why it's not going to work, right? And a lot of newsletters and a lot of research gets published around that. But long term, it turns out just being long and relatively perma-bullish tends to be the right idea. Market timing rarely, if ever, works. Getting it right once is luck, twice is, just really, you just happen to really get lucky. It's hard to really time that, and I wouldn't try. I think investors are smart just to kind of play the trend here for a while. It's going to continue to work, it seems. When it doesn't, you'll have the opportunity to back off and reposition. But it's why we encourage investors generally to have an asset allocation, have a plan, and stick to it. So when you get things that you think are maybe getting a little too frothy or a little too nervous, you don't have to make that big of a change to your portfolio. For the short term, though, it does seem like there's a lot of enthusiasm for equities. There's a lot of cash coming back in. There's been a historic amount of money sitting on the sidelines in money market funds. Not all of that's going to come piling back in, but you don't need a whole lot of it coming in to just keep this rally pushing through for the next few months.
Alexander, is the case of FOMO setting in once again, do you think, for investors?
I would think so. I think a lot of folks felt like they missed out on a handful of what folks might now say are easy trades, but this one's a pretty simple one. Just stay put. Most folks were relatively well positioned to be long equities. They should stay there. For your other cash, the short end of the curve, still nice, reasonably great return still with a 4 handle on them. Those were unheard of a decade ago. So you've got a pretty simple barbell approach here that I think investors are pretty well positioned for. If you want to start to really take advantage, though, you can start to extend your duration. You can get into some, shorter term, midterm investment grade credit if you want more yield. But otherwise, any of those are good choices, and it seems like it's a pretty good place to be.